Hello, Business 202. This pre-recorded Google Hangout will focus on Chapter 16, Learning Objective 2, Worksheet Preparation of the Statement of Cash Flow. You will understand the content of this Hangout better if you have viewed the lead videos about the Statement of Cash Flow appearing on Business 202's course calendar and have viewed the related CengageNOW exercises. Before starting this Hangout, please turn to page 730 and 731 of your accounting text to follow the example that you see in Exhibit 3. And as always, please email your questions, comments, and other feedback about this and other Google Hangouts so that I can make adjustments and respond to your questions. Be successful. As you can see from the chapter outline, there are 4 objectives for the statement of cash flow. Describe the cash flow activities reported on the statement of cash flow, and as your videos from the Google Calendar will indicate, there are 3 activities: operating activities, which come from the income statement; investing activities, which represent buying and selling assets; and financing activities, which represents raising capital through either debt or stock. Secondly, which is the main focus of this Hangout, is Learning Objective 2, prepare a statement of cash flows using the indirect method. And what we're going to show you shortly is how to do an Excel spreadsheet. And you know, as you go through the chapter, it looks like there is a lot that you need to memorize. I don't do that, and I don't want you to do that, but I'd like to show you a method that is straightforward, that prohibits or allows you not to memorize and still get the statement of cash flows right. We'd also like you to be able to interpret the statement of cash flows, both the indirect and the direct method, and then describe the free cash flow and how business people use that. Learning Objective 4 is covered adequately in the e-lecture and the animated example, and unless there are questions, I will not address it in this Google Hangout. Before we start the Hangout itself, a couple of items that I'd like to point out to you from the Google Drive and the CengageNOW. First, turn your attention to the Moodle page that we have. I put this up last week as a way for you to keep track of all the assignments that are in addition to CengageNOW. Pardon me. For each of the chapters, there will be discussion questions that I would like you to write up answers to in a single sheet and upload them to your Google Drive. And also within the assignments, there will be narratives and spreadsheets that you should also upload to the Google Drive. And before we begin discussing a particular chapter, what I will do is to upload those specific items that you should upload to Google Drive, and you can check your scores after the due date on Moodle. Also, Moodle will highlight with these yellow bars the current topic. So you can see today we are on Chapter 16, and that is highlighted with Google. Excuse me, not Google, but highlighted in yellow. Also, what we will be able to do for tomorrow is to make use of the annual reports. The cameo company for this chapter is Jones Soda Company, and Jones Soda Company's annual report will be under class notes under the annual report folder. And so tomorrow we will access that particular folder. So please make sure that you can download the annual report for tomorrow's Google Hangout. Also, just to turn your attention to the course calendar, just a reminder, what we will be working on today is learning objective number 2, preparing the statement of cash flow using the indirect method. And I think it would be a good idea to review the animated examples and the e-lectures that are available from the Cengage website before going on with this particular handout, because they give you some good preliminary information. Also, I think it would be very good if you would view the lead videos, pardon me, from the excuse me, YouTube, as they give you some good introductory material, and especially the third item, the cash flow statement of 4 real companies, Walmart, Sears, Intel, and Eastman Kodak. There's a review of how to interpret the statement of cash flows. And as always, with Cengage, there is specific due dates that are mentioned with each of the assignments. And so the assignment for Chapter 16 and Chapter 17, for Chapter 15 and Chapter 16 will be due on June 30th. Okay, let's turn our attention to the outline, and let's begin the discussion about how to prepare the statement of cash flow. Okay, as the outline mentions, there are 3 distinct areas to the statement of cash flow: operating activities, investing activities, and financing activities. Now, why are these important? Well, let's take a look at the example that you have on page 630 or 730 and 731, Exhibit 3. And what you see on your screens now is the setup that you could use in an Excel spreadsheet to prepare the statement of cash flows. Essentially, what you need to prepare the statement of cash flows is the current year's income statement and the balance sheet for the current year and the previous year. The statement of cash flows is all about change. Specifically, you want to explain to the owner why cash has changed. So, for example, for the Rundell Company, the business owner will see that cash has gone up from $26,000 in 2013 to $97,500 in 2014. And so the owner will see that cash has gone up $71,500. But the owner is also going to notice, when the owner reviews the income statement, that sales were $1.18 million, less all the expenses, leaves net income of $108,000. And the owner will ask, well, if I have income of $108,000, why did my cash go up only $71,500? Who has been stealing my money? I want to know right away. Well, the statement of cash flow is designed to do just that. It reconciles the net income that's reported on the income statement to the change in cash, so that the owner will know specifically why the amount of income differs from the amount of cash. To give you another example that's a little bit more personal, let's think of the summer jobs that most of you have right now. At the end of the year, usually in after the New Year's in January, you will begin receiving your W-2s. And the W-2 forms that you get report the income that you would have earned during the previous calendar year. If you would compare the number on your W-2 to the balance in your checking account, very rarely are those two the same. Why? Well, there's been some other activity of spending or other deposits that aren't reflected in the W-2 statement. What the cash flow statement does is to reconcile why those two items are different, and for a business, it explains those differences in terms of operating activities, investing activities, and financing activities. Okay, so before we get into the nitty-gritty details of making the statement of cash flow, let's try to answer for this particular owner of the Rundell Company why income was $108,000, but the increase in cash was only $71,500. Okay, excuse me. Well, let's start the statement of cash flow with the net income that you see right from the income statement. Because the income statement is comprised of accrual income, income that may have been received in cash, excuse me, income that might have been earned but not received in cash, and there may be some non-cash expenses in the income statement like depreciation, there will be a difference between income reported and cash receipts and cash disbursements. So we would tell this owner, well, from running the business that you have been running, even though you've reported $108,000 of income, because of the non-cash depreciation and because of a gain that is counted elsewhere in investing activities, this particular business owner sold some land at a gain, and because of changes in the current assets and current liabilities brought about by the accrual process, which monitors income rather than cash flow, your business only generated $100,500 in cash, even though you reported $108,000 on your income statement. Additionally, because of selling a piece of land and using some of those proceeds to buy a building, your business used up a net of $3,000 more. Also, under the financing activity, your business paid to its shareholders $24,000 of dividends, which is a good thing for you and your owners because your business is returning cash to them. You also paid down $50,000 of a bond payable that was outstanding, so the ability to pay down debt is a very good thing. And you also issued new stock of $48,000. The result of paying dividends, paying off the bond, and receiving stock was that financing activities used up $26,000 of cash. So when analyzing the cash flow from operating activities, a positive $100,500, the cash used net from selling land and buying a building, and the cash used net from paying dividends, paying off bonds, but getting some additional equity capital by issuing stock, used a net of $26,000. The sum of these three cash flow components shows the increase in cash, $71,500. So the increase in cash on the statement of cash flow should always equal the cash change that you see as the difference between the ending cash from this year's balance sheet and the ending cash from last year's balance sheet. So if we would take that increase in cash plus the cash that the business had on January 1, the final number on the statement of cash flow would be the ending cash that you would see on the current balance sheet. Okay, that is the interpretation of the statement of cash flow. Now, let's take a little bit of time, most of our time, to review how this is done and how you would prepare one of these statements of cash flow. Pardon me. The statement of cash flow is all about change. And if you would look in your textbooks on page 730, the textbook is beginning to explain how the statement of cash flow is prepared. And here's the deal. you know that on any balance sheet, the total of the assets should equal the total of the liabilities plus the total of the owner's equity. And in this particular formulation right here, we're showing debits and credits and not increases or decreases. So all of the asset accounts will have debit balances, and the liabilities and the owner's equity will have credit balances. So if the total of the assets equal the total of the liabilities plus owner's equity, if we would take the total of the assets and deduct the liabilities and deduct the owner's equity accounts, that difference would be 0. Okay, so here's the deal. We know assets equal liabilities plus owner's equity. The objective that we're after is that the change in cash can be explained by the changes in every other account on the balance sheet. Let me say that again. The main objective is to say the change in cash can be explained by the changes in all the other accounts on the balance sheet. What the introductory comments on page 730 of your textbook try to do is to show you why that is the case. So let me just take a little sidebar here and show you why that happens. And what I'm going to do is to just show you in a formula format what page 730 is trying to explain to you using text. The premise of this entire section is based on the balance sheet equation, which says that assets equal liabilities plus owner's equity. We all know this, and we all understand how this works. What we are going to do now is to add some detail by adding more accounts. As you can see from the as you can see from the balance sheet, there are many more asset accounts other than cash. So let's just say that the left-hand side might be comprised of cash plus something that I will label here NCA to represent non-cash assets. So accounts receivable all the way down through accumulated depreciation will be the non-cash assets. So cash plus non-cash assets, or total assets, would equal the liabilities plus the owner's equity. Okay, now let's take a look at the owner's equity. Owner's equity is comprised of different items. There would be the contributed capital, which would be the issuance of stock, whether it be preferred stock or common stock. And then there would be the earned capital, which is what the business gets from its net income. So just to review, total assets can be shown to be comprised of cash plus NCA, the non-cash assets. Total assets must equal all of the liabilities plus equity, which is comprised of common stock, preferred stock, contributed capital, and earned capital, which would be retained earnings. Okay, now let's take another look at retained earnings. What causes retained earnings to go up or down? Well, retained earnings comes from the net income, and net income is or has its source as the income statement, which represents sales less all of the expenses. Pardon me. So let's say that retained earnings will be comprised of net income from the income statement less any dividends that have been distributed to the owners. So now we have the right-hand side of the balance sheet comprised of liabilities plus contributed capital plus earned capital, which is net income less dividends, and that should equal cash plus the non-cash assets. Where are we going with all this? Well, we're trying to explain cash. So deducting the non-cash assets from both sides of this long equation will give us cash equal to liabilities plus contributed capital plus net income less dividends less non-cash assets. Now, one more step and we're done. There is a mathematical rule that says, like we did here, if we perform one mathematical operation on one side of the equation and perform the same mathematical operation on the opposite side of the equation, the equality still holds true. That's regardless if we add a value, subtract a value, divide by a value, or multiply by a value. Also, we could take the change between the beginning and the ending balance. And so what we could have, if we subtract the values in two balance sheets, we would have the change, the increase or decrease in each of these columns, so that the change in cash is equal to the change in liabilities plus the change in contributed capital plus, now net income itself represents the increase in retained earnings. So net income is a change. So we will leave that as it is, net income. And dividends represent the deduction in current year's retained earnings. And so dividends would be a deduction, a change. We leave that value as it is, less the change in non-current assets. So this particular equation right here is the mathematical basis for the statement of cash flow. What we want to do is to say that the change in cash is equal to the change in all the other accounts on the balance sheet. And once we have explained the change in all the other accounts on the balance sheet, we will have explained why cash moved from its beginning balance to its ending balance. The only other thing that we need to do when we explain those changes is to categorize them into operating, investing, and financing activities. Okay, let's try that right now and see how the accountants will make this item work. Remember, what we are trying to do is to explain to the owner why income is one figure, in this case $108,000, and why cash went up by a different amount, $71,500. Okay, so let's see how the accountant will go through this. The balance sheet here, the change is the most important item that we want to deal with, and this is set up so that positive amounts represent debits to these respective accounts, and negative amounts represent credits to these accounts. The place to start is with operating activities, and on the balance sheet, net income increases the retained earnings, so retained earnings is the place we will start. Remember that debits must equal credits and that net income is a credit balance account because it increases retained earnings, which resides on the credit or right-hand side of the balance sheet. So we are going to make a series of journal entries to show what changes in the balance sheet happen and what related change will happen in the statement of cash flows. So for example, income has increased $108,000. We get that directly from the current year's income statement. We increase retained earnings with a credit. Any item in the statement of cash flow would change with the opposite leg of the entry. If you credit net income on the balance sheet, you will debit net income or debit the cash flow statement for net income in the statement of cash flows. Here's a key. This statement of cash flows you can think about as a giant cash account. Cash lives on the left-hand side of the balance sheet, is increased with debits and decreased with credits. So the credit to retained earnings is offset by a debit increase to cash because the business earned income. Okay, now the income statement is comprised of some items that do not necessarily result in the flow of cash. One of those items is depreciation expense. When a company incurs depreciation expense, it will debit the account depreciation and credit the account accumulated depreciation. Let's take a look at that specific entry. When a business incurs depreciation expense, it will debit depreciation expense and credit accumulated depreciation. Now, if you examine that journal entry, how much cash or how much did cash increase or decrease? Well, because there is no debit or credit to cash in this journal entry, cash was not affected, and so there would be no effect on cash. Because cash, excuse me, because depreciation expense reduces net income but doesn't reduce cash, what we must do is to increase net income by the amount of non-cash depreciation. In short, here is how that works. The change in accumulated depreciation comes about because we increase depreciation expense. Accumulated depreciation is increased with a credit, so the opposing side of the entry, the debit, would go to depreciation expense in this giant cash T account. Okay, got it? Cash depreciation is a non-cash expense that's in the income statement. It reduces net income, but does not reduce cash. So what we do is to adjust net income upward for any non-cash revenues. Let's move on to the gain on sale of land. The gain on the sale of land is an example of a non-cash revenue. Okay, so how does it work in this particular example? Well, this particular company wound up the year with $80,000 in its land account, but started the year with $125,000 in its land account. That means that the land account must have decreased by 125 less 80, or $45,000. Let's make a journal entry for that. To remove the land from the account, we should decrease or credit land $45,000. Also, from the information that we have on the income statement, this particular company had a gain on the sale of land of $12,000. A gain is like a revenue and increases retained earnings. Because retained earnings is on the credit side of the balance sheet, the gain should be increased with a credit balance. Okay, so if the land originally cost $45,000 and the company sold it at a gain of $12,000, the amount of proceeds from this sale must have been $45,000 and $12,000, or $57,000. That is the amount of the selling price and the cash that the owner received. But because land is not an operating activity, it involves the buying or selling of an asset, this would be known as an investing activity. And so for this particular example, the proceeds, $57,000, should be shown in the investing activities cash from the sale of land. But wait a minute, what about this credit here? It has also affected the income statement. It shows up as an increase in net income. If we would continue to report it on the income statement and not adjust it, we would overstate the cash effect by the amount of the gain that's reported in net income. So any gain represents a non-cash revenue that we must adjust net income downward for. In short, this particular entry would involve a $45,000 decrease in land. We would show an adjustment to net income credit of $12,000. Excuse me. And we would show cash from investing activities, pardon me, from the sale of land, $57,000. Okay, all right, so that takes care of the gain on the sale of land. And these first two were really the hardest. The rest of them, as you will see, are fairly straightforward. So let's work on them. From here, what we can do is just very methodically go through the accounts on the balance sheet one by one, and if there is a debit that's needed to show the change from the beginning to the end of the year on the balance sheet, we will have an opposing credit in the statement of cash flow, which operates like a giant T account for cash. Okay, so let's just go ahead and work on these items. Okay, here you see accounts receivable moving from $65,000 to $74,000. So accounts receivable has increased $9,000. An increase in accounts receivable is shown by a debit. The debit to accounts receivable is offset by the credit to the cash flow statement. Why would we do that? Well, here's an example. Accounts receivable went up $9,000. And why did accounts receivable go up? Well, it must have been because sales had gone up. This company sold items on account. If you would examine this journal entry and ask the question, how much did cash change because of making a sale on an account, your response would be cash did not change, because there is neither a debit or credit to cash in this journal entry, so a sale on account does not affect cash flow. But because it affects net income, we must adjust net income downward for the non-cash revenue that's reported on the income statement from selling to a customer on account. Next up, we have inventories. Inventories went from $180,000 to $172,000. So inventories went down. Inventory represents an asset. Assets are increased with debit balances. decreased with credits. So we will credit the inventory account on the balance sheet, and we must show a debit in the statement of cash flow. Next item is land. And remember, land is a long-term assets, and here is where the investing activities start. So any change that comes about from land, building, or changes in intangible assets would be an investing activity and not an operating activity. So land, as we just mentioned, started the year at $125,000, went to $80,000. So there's a decrease in land, $45,000, that we would credit this account. We also know from the income statement that there was a gain of $12,000. And so that gain represents a non-cash revenue that we should reduce net income by. The balancing entry would be an increase in cash from investing activities, $45,000. Okay, next up is building. The building account went from $200,000 to $260,000. Building is an asset and would be increased with a debit side entry of $60,000. The debit on the balance sheet would be offset by a credit to the statement of cash flow. In this case, since the account was a building account and represents a long-term asset, this decrease would be shown under investing activities as a credit. For the accumulated depreciation comes about because of depreciation expense on the income statement. Accumulated depreciation is an offset against the asset, so a credit to accumulated depreciation would be the equivalent of crediting an asset. An asset account would be increased with debits and decreased with credits. And so the credit to accumulated depreciation would effectively decrease the asset account. The decrease in accumulated depreciation would be shown as an increase to cash for the non-cash expense that depreciation represents. Okay, let's move on to the credit side of the balance sheet. Accounts payable through dividends payable will be the current liabilities. Any current liability, with the exception of dividends payable, excuse me, is an operating activity. Dividends payable, because they relate to investors who contribute money to the corporation, would be considered a financing activity. So that is a star to put besides dividends payable. Dividends payable would always be a financing activity. Okay, so let's take care of these items. Accounts payable went from $46,700 down to $43,500. So accounts payable, a liability decreased. Liabilities are on the right-hand side of the balance sheet, so they would be decreased with left-hand or debit side entries. The debit of $3,200 on the balance sheet would be offset by a credit or reduction in cash flow. Accrued expenses are other liabilities. In this case, you can see accrued expenses increasing. They went from $24,300 to $26,500. To increase a liability, you would credit the liability. The credit on the balance sheet would be offset by a debit to operating cash flows. Income taxes payable would be next, and you can see the company paid past taxes. Beginning of the year was $8,400. The end of the year taxes was $7,900. So accrued taxes went down. To decrease a liability, you would make a left-hand or debit to the liability. The offsetting credit would go to cash flow from operating activities. And let's turn our attention to dividends. We said dividends represent a financing activity because they are associated with common stock, which is a financing activity. Dividends payable went from 10,000 to 14,000, so dividends payable went up 4,000. To increase a liability, you would make a credit side entry. So the credit of 4,000 for the dividends payable liability would be offset with a credit to the financing activities. Okay, well, wait a minute. We have $4,000 here showing the change in the balance sheet, but there would be $24,000 down here in the financing activities. Okay, Rosengarth, what gives with this deal here? Okay, well, one other item to remember with dividends is that two accounts are affected when dividends are declared. One account might be any dividends payable, but the second account would be retained earnings. So let's examine the retained earnings account. Retained earnings resides on the right-hand side of the balance sheet, so it would be increased with right-hand entries. So retained earnings begins the year with $202,300, and it ends the year with $282,300. We know net income would increase retained earnings, and we know dividends would decrease retained earnings. We will represent the net income on the credit side because of the increase. We will represent dividends on the debit or left side because of the decrease. We already know that the company has earned $108,000 of dividends. Okay, now let's see. If we would examine what we've done so far, we have $202,300 as the beginning balance in retained earnings. And if we would add the net income of $108,000, oh boy, that gives us $310,300 as a tentative balance in the retained earnings. Okay, well, our ending balance is $282,300. What could be that difference? Well, there must have been some reduction in retained earnings. Because we know dividends reduce retained earnings, by inference, we'll conclude the difference between our tentative balance and the desired balance would be dividends. So let's subtract the tentative balance, 310,300, and the desired ending balance that we want. The difference is $28,000. And by inference, what we will say is that dividends for this period would have been $28,000, and that is the amount that we will reduce or debit the retained earnings by. So just to review that logic, retained earnings began with $202,300. We increased or credited retained earnings for the $108,000 of net income, and we want to attain an ending balance of $282,300. Because beginning balance and net income added together gives us too much, there must have been something that reduced retained earnings, and what reduces retained earnings is dividends. So we infer the difference between the subtotal that we get and the desired balance that we want would be the dividends that the business declared. Okay, so let's make a journal entry, excuse me, to record the declaration of dividends. We know the retained earnings must have been reduced by $28,000. And from the change in dividends payable, we had an increase of $4,000. Well, debit of 28 and a credit of 4,000, that difference is $24,000. That must have been the amount of cash that this company paid for dividends. And dividends would be a financing activity that we would show under the financing activities in the statement of cash flows as a credit. Okay? Okay, all right, so that takes care of the dividends. Going on to the long-term liabilities, you can see that the bonds payable began the year at $150, went down to $100,000, or decreased $50,000. To decrease a liability which resides on the right-hand side of the balance sheet, you would debit it. The debit to the bond payable would be offset by a credit to the cash flow account. To pay off a bond payable, you must have paid out cash, and so we show this as a cash credit or a cash outflow. Going on to the remaining accounts in the equity area of the balance sheet, common stock went from $16,000 at the beginning of the year to $24,000, so this account increased by $8,000. Common stock is a credit balance account that would be increased with a credit entry. The offsetting debit would be to a financing activity for common stock. Okay, now wait a minute. Here you see common stock, $48,000. What gives? Another item to remember. Common stock and paid-in capital go together. In other words, when a company reports common stock that is sold, only the par value will be entered into the common stock account. Any excess of the IPO selling price over the par value is included in this account, additional paid-in capital. So the journal entry to record the issuance of stock would be an increase in the common stock account, $8,000, and I will abbreviate common stock CS, and the additional paid-in capital went from 80 to 120. It increased $40,000. So let's increase additional paid-in capital. We would need to balance this entry a debit side entry of 40 plus 8, or $48,000. Well, what happens during an initial public offering of common stock? Investors buy shares. And what do they pay for those shares with? Well, cash. And so this balancing amount would be $48,000 as a debit to cash, and we would classify that as a financing activity in the statement of cash flow. So, that's why we would have $48,000 in the statement of cash flow. Okay, now what we have done is to explain all the changes in all the accounts on the balance sheet. Once we have done that, we should have explained the change in cash. To prove it, let's just take our calculators and add up each of these values. And I'll encourage you to pause this particular Hangout, get your calculator, and add up all of these values. When you do, the total value should be $71,500. That is the change in cash. And what that illustrates is that, pardon me, once we have analyzed the change in each of the accounts on the balance sheet, we would have explained the change in cash like this formulation here shows us. Okay, now we have a little bit of house cleaning to do in the statement of cash flows. What we want to do is to sum the amounts for operating activities, and when we do that, they total $100,500. We sum the amounts that represent investing activities. That nets to a decrease of $3,000, and then we sum the amounts from financing activities, and that nets to a decrease of $26,000. Adding the cash inflow from operating activities and the cash outflows from investing and financing activities gives us an increase of cash of $71,500. That should always match the change in cash here. Add the beginning cash should get in the statements is the ending cash, $97,500. Okay, that is the general background behind the preparation of the statement of cash flow. To summarize, the change in cash can be explained by the changes in all the other accounts. Whatever debit is necessary to explain a change in the balance sheet is offset by a credit to the statement of cash flow. Whatever credit is necessary to explain a change in the balance sheet is offset by a debit to the statement of cash flow. If you would methodically analyze each account on the balance sheet and record the opposing debit or credit to the statement of cash flow, once you have analyzed the change in all the accounts on the balance sheet, you would have explained the change in cash. Okay, that will end this particular Hangout. In a separate Hangout, what I would like to do is to demonstrate the use of Excel in solving one of the problems that you have as an end of the chapter assignments. In the meantime, watch the e-lectures, the animated examples, and especially the lead videos explaining how to interpret the statement of cash flow and give the end of the chapter activities a shot. Thank you for listening.